The first goal in real estate is to get to the point where you have capital, right? Capital will set your true time freedom because you can redeploy that capital in a lot of different ways. You can put it back into real estate. You can put it into other types of business ventures. But in the end, for most people are trying to deal with time freedom in being a syndicator or anything like that, or doing the flips or managing your own properties so that you can maximize your cash flow that you're getting back out of those assets. Those are all going to consume time. And ultimately, to escape that, whether it's syndication, the rental portfolio, whatever it is, you need to get passive.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Jeremy LeMere. Jeremy is the managing principal of Star Capital Management Group, where he helps investors achieve above average returns outside the stock market through real estate. Jeremy, welcome to the show.
Thanks for having me, Tim. Look forward to the conversation.
Yeah, let's get into it. So I'm excited to hear about all the different asset types that you're invested in. But first, please tell us about how you got started in real estate and how you got to where you are today.
Sure. Yeah, it's been a long road, actually. Real estate first touched me when I was probably in middle school. My parents they were in the passive income, I'll call it, concept, but they actually never were passive. They were active landlords. I had a couple duplexes that they bought over time, but blue collar, fix them yourselves and do all the dirty work, even mowing the grass. Interestingly, it was one of the first entrepreneurial exposures that I had was related to the duplexes because my parents actually had us purchase the lawnmower and the weed eater and things like that and contracted with us to do those activities way back then. A lot of years went by. My parents still own the duplexes. In fact, my mom, now fully retired, just recently sold the last one. But during that whole time, I went out and I got myself a corporate job, did engineering work for 20 some years. And ultimately, towards the end of that career, I finally was able to settle down and not transfer around with my company anymore. And the Great Recession set us up in a really good position to say, hey, let's get into real estate. Pricing had really pulled back significantly. Cash flowing assets were readily available for purchase. So we started buying some of the, I'll call it B-class duplexes and things like that. With the Great Recession, things were pretty tight from a lending standpoint. So we really got cut off pretty early. We had to really go digging around with multiple lenders and stuff in order to try to find more money to borrow from other lenders because they were really restricted to, hey, you're not a seasoned investor, so why don't you do this for a little while with one or two properties, and then somewhere down the road, we'll give you some more money when we know that you can handle this. So ultimately, I made the transition in order to raise more capital. We got to the point where we started going out and doing fix and flips, tied up some more of our time as we were getting seasoned and also to buy better valued properties with a little bit of a different twist on what we were borrowing money for compared to just rentals. So we did some fix and flip stuff. Then we would BRRR a property, do another fix and flip, BRRR 2 or 3 properties, and then do a fix and flip, BRRR several more properties. We really reached the point around probably 6 years in, 5-6 years in, where we had a lot of individual houses, duplexes, and we wanted to get to scale, right? We wanted to get out of the full-time job. And now with 10 to 12 properties, you're at that breaking point where it's almost too much work for a full-time job and to do the activities and manage and everything, because I didn't have a property management company. It's just what I didn't know at the time. We self-managed everything. And to this day, we continued to self-manage. We stood up our property management company in order to address that. But we went down the path of getting into apartment buildings. And so we wanted to scale faster. So we bought another 50 units of apartments and larger multifamily properties. And all of that was organic, right? At that point, we were still purchasing stuff with our own money, redeploying the capital that we had built up in the assets that appreciated over time from 2011, 12 on through 2018. And we just kept building that portfolio out. And around 2020, we really reached the point where, okay, I was able to leave my full-time job if I wanted to and had property management stuff starting to set up and put a team in place for that, virtual assistants to answer the phones. But we really saw ourselves needing to jump one more set bigger in order to have that management be very effective and properly leveraged. So at that point, multifamily cap rates were really falling significantly. So we migrated over to self-storage, and we wanted to stay in our backyard. So by going to another asset category, it gave us the opportunity to re-leverage our property management in the same geography while still finding assets that really made sense from a cash flow standpoint. So we actually went out, worked with another business partner, and we started syndicating. And this was the first kind of time that we actually went out and pulled in investor funds and raised the capital necessary along with some of my own capital to actually get into self-storage. At that point, we went out just under a year. We went out and bought 1,000 doors of self-storage, and that gave us the scale in the storage side, which then left the property management company really in good shape to operate and call it a full work week with the staffing that we had set up. So we marched forward for a while with that. We continued to dabble in some additional apartment stuff, and in reality, we started picking up some commercial properties. So some storefronts and things like that. We had acquired 2 or 3 doors of that with some of our self-storage. So it gave us an exposure to that. And we continued to grow that element of it in our backyard. At that point, I was able to leave my full-time job. And ultimately, at the point now where we're hitting, I'll call it our life cycle on a standard syndication coming up in the next year and a half. So we're looking at potentially exiting those deals if it's appropriate. And if I exit, I'm actually going to be working on, I'll call it scaling back, because the reality with syndication is you're a general partner in the syndication model and you've got active work to do. So for myself, it was a necessary step in order to, I'll call it, to stay occupied, but I'm at the point now where financially I don't necessarily need to be contributing that time to others from an outside general investor standpoint. And we're going to start scaling back some of our active businesses and starting to migrate ourselves to more passive configurations. So we're going to exit some of those GP syndication structures, move those funds into a fund of funds model where we're actually able to do hard money lending, maybe some smaller syndication deals that we partner with someone else who is the primary GP on the activity. And we'll go from there and work with our investors that want to stick around to get those returns, work on some other types of deals and with a little bit different perspective of time use. So that's the 15-year journey for myself in the real estate since I started back in 2010.
No, that's awesome, because like I'm hearing your story and like the little steps that lead up to bigger and bigger things. And it's pretty much textbook how, if one was going to do it in the most logical ways, that's exactly how, like I would have done it had I known, right? And a lot of people are looking for that. And it's such a great like roadmap for how to get from step one to where you're at now, because it seems like you went to the next step in each progression because it made sense, right? Or because there was a business necessity behind it. Yep. So I'll start at the beginning of some of the stuff you were talking about. Sounds like you had a pretty unique advantage in that your parents were doing the real estate thing. So you got exposure to it. And it sounds like they were savvier than you're letting on if they were hiring their own kids, because I've heard a lot of CPAs talk about that just in terms of these like niche tax advantages you could get and stuff from hiring your own children. You got to stay within the rules and the laws and everything. But I'm impressed with that already. My kids are 6 and 9 right now, so I don't know how much work I could have them do. But
9 is good. 9 is good. They're ready to be painters at 9.
Yeah. But if nothing else, just like your parents, I'm trying to at least expose my kids to this stuff. Yes. And then, hey, maybe by the time they go to school, what I'm thinking about is getting them a duplex and saying, hey, you're in charge. You live on one side, rent out the other, whatever, to your friends, so that they're forced to learn business and they get all those lessons along the ways. Because I think they may hate me at first, but they'll definitely thank me down the road.
Be careful with that one. I have friends that have done that. And the reality is the child can become savvier than you think. They're going to stay living with you and they're going to rent both sides of it out.
Yeah. No. Yeah. Why not live rent free? No. And then going on past that, you talked about obviously the Great Recession, a lot of bad things, but it also presents opportunity, just like anything else. But you also mentioned the unique aspect of that, which was, hey, there was all this supply as a result of what just happened. But at the
Yeah.
same time, lenders had learned their lesson too. And there was a snapback in terms of who was getting loans, how much they were getting. And capital was very restrictive at that point. It sounds like you were still able to make it work to an extent, but you hit the end of your rope there at a certain point.
Exactly. And what's interesting, we hit that limit and we ultimately stepped aside and at that point learned about, and this is early on in the days of self-directed IRA activity, the internet kind of led the path to being able to learn more about alternative asset classes for self-directed IRAs even. And frankly, the folks that can actually put those packages together, because there were way less companies that handled that product at the time, as well as lenders. There were only two banks in the country that you could find that would lend to a self-directed IRA. Yes, it had a limit on normally you could get a 70 to 80% LTV. They were limited more at 50-50, but it was still an opportunity. And if you knew that appreciation and high cash flow was there, it was a great opportunity to package real estate within the self-directed IRA. So we did that early on at that point too, to help grow it, because that was asset-based lending. And it escaped the limitation on us as individuals about having more rental properties based on the bank looking at us as individuals owning our own real estate. The self-directed IRA situation was its own entity doing the activity, and it gave us the ability to double down on the number of assets that we had for that short window of time.
Yeah, that's interesting because I have a solo 401k. And so I've used that for passive investing, right? Because I have
Mm-hmm.
like checkbook control, but I hadn't really thought about it as much using it as an entity and holding the property within it. But now that I think about it, when I was in grad school, I was renting from this older couple, and the apartment itself was part of their retirement account. So I'm guessing that they had something similar, and that's how they were able to do it.
Sure. Yep. Yeah. And it's a great opportunity to get that appreciation in a bucket, tax free. There's puts and takes on different aspects and different types of accounts. It's really important that you learn what those limitations are at the right point in your investment career. Some things work well, and other points you may start to divest back out of it and do other things, other strategies, for sure.
Yeah, and you brought up BRRR in there. And just for the people in the audience who might not be familiar with that method, can you walk us through the BRRR method?
Sure. So ultimately, if you have the opportunity, in my case, I had built up enough equity, I could actually buy the asset, and I'd buy a discounted property, usually like a house that was substantially damaged, flooding or something like that, get it at a pretty steep discount, take that property and do the rehab on it and get it prepared for the market. And then ultimately we would then start the rental process and put a tenant in it. And at that point we would go refinance it. Effectively, I had self-financed it, but we refinanced ourselves out of it and put a bank loan on it with the income that's coming in against it. And then just let it sit and pay down the equity and let it create the cash flow. And we take our equity and move on to the next one and effectively repeat it in the next asset.
Yep, makes a lot of sense. And you hit on something with the fix and flips, and I do hear a lot because so many people that are in real estate do it at some point. But what I've found is that they realize, well, it may be a good opportunity to build, a lot of capital quickly, hopefully, right? If things work out. The problem is, one, the taxation, right? It's taxed very heavily because of the short-term duration on it, short-term capital gains. And then the other side of it is the amount of work that you need to put into it while flipping and fixing, actually, all parts of it. And so it becomes almost like a job in and of itself. So especially people who have a regular 9-to-5 job, they just find it to be too much at a certain point, and then they tend to transition into either passive investing or active investing on the syndication side of things, where they can make their own hours.
The first goal in real estate is to get to the point where you have capital, right? Capital will set your true time freedom, because you can redeploy that capital in a lot of different ways. You can put it back into real estate. You can put it into other types of business ventures. But in the end, for most people are trying to deal with time freedom, and being a syndicator or anything like that, or doing the flips or managing your own properties so that you can maximize your cash flow that you're getting back out of those assets. Those are all going to consume time. And ultimately, to escape that, whether it's syndication, the rental portfolio, whatever it is, you need to get passive. So you need to find a way to either build the right portfolio so you can pay for the property manager so you can actually escape that, but you're still going to manage the manager. Or you have to, like you mentioned, get to the point where you're truly passive by investing with someone else who's doing what you used to do on the active side. They're responsible and can do the same thing for you, and you be the silent, I'll call it silent partner or the limited partner, and actually just be able to receive the income from your investments. That in the end is the ultimate goal.
Yeah. And I'm so glad you not only brought that up, but articulated it, because I've said this before, but it's funny to me when I hear so many syndicators or fund-to-fund managers, and they act like they want to be doing this forever. And I will be the first person to say, no, the ultimate goal is I want to be that LP. I want to be that limited partner who's in 10 or 20 deals and just sitting back and getting all the benefits of real estate without having to do all the work up, throughout. And granted, do limited partners, or should limited partners do some work? Absolutely. Yep. Vetting the deal, vetting the partner, or vetting the GP. Sure. I'll grant that. But in the grand scheme of things, they're not sitting in on property management meetings. They're not going to the asset manager meetings. They're not going to the GP meetings, all these things that are required legally and otherwise for the deal for those general partners who are more active. So yes, amen. One day I want to be on a beach sipping a Mai Tai while I'm heavily invested in multiple deals, across a spectrum of different assets.
Yeah. I would say that what's really nice about the migration across the spectrum of, you're going to transition from a W-2 job. If you find an area, a niche within the real estate part that you can be focused on, that you can be passionate about, you'll be way more successful than I do this real estate thing because it's only a bridge to get to the other side. But one of the most important elements of it is, I'll call it the flexibility and time freedom. If you're doing a 9-to-5 job 5 days a week, that is commitment every day for those 5 days. You might get some vacation in there, right? Depending on how veteran you are in the organization or what you can negotiate. But the reality is you still have a pretty rigid schedule. Mm-hmm. When you get to the real estate side of it, you can start to be the boss, to start to structure your resources around being gone for long weekends all the time, or extended vacations all the time. Or in my case, my wife is a teacher, and my kids during the summer, it's an infinite amount of vacation possibilities, right? I'm the only one that may still have to touch my email from a remote location in order to keep things moving, but everybody else is free to do whatever. If you can get 2-3 hours in before they get up in the morning or while they're getting ready for the day, you can have your tailored back work schedule all taken care of, and you can keep everything moving and be where you want to be, do what you want to do. And still then when we come back to the normal school year, I can spend more time doing certain things or take care of that next flip that we purchased or structured into a BRRR strategy, have those things lined up and take care of them during those times when you're constrained in from other family members' timeframes. So to me, the flexibility that you get going from a W-2 into it to continue to generate income, build that nesting that you need, then be able to go passive later on and have 100% time freedom and just deal with your investments from wherever you want to deal with them, or hand them off to a responsible person that you can count on to deliver for your retirement for the rest of your life at that point.
Yeah, exactly. It's a matter of you get to set the dial of how active you want to be based on your time freedom, because you're not beholden to that, hey, better be in the office by 8:30 and not leave until 4, whatever the case may be. All right, let's talk about some of the different asset types, because you mentioned this evolution, and it's not to say that you dropped one in favor of the other. It sounds like you're doing all concurrently. So talk to me about what I think you talked about what prompted the shift to self-storage, but what benefits did you see in self-storage that you weren't seeing in multifamily at that
Sure.
time?
Sure. There's two really big parts to this. One is you have to be able to sleep at night, right? And to come from a world where you haven't done real estate, make some folks get into this and they haven't even owned their first home, right? Their first investment is a rental property. It's not their house. And that's fair because at certain times, like maybe right now, you're better off renting and renting from yourself, right? With the cost of a home and the payment and what is the better value.
Yeah.
That moves around over time. But ultimately, I had already owned a home, had done renovation stuff on properties, and come from a background that is technically oriented. So hands-on for me was normal. So I was comfortable with that. So that was my entry point. And ultimately, it was, how do we do more properties? It was always a fear of what you don't know, and get enough knowledge and education, get a peer group that you can bounce ideas and concepts off of, and you can continue to grow in your real estate endeavors and be comfortable so you can sleep at night. Because once you can't sleep at night, your health is going to deteriorate and there's lots of problems, right? And you have to figure out how to grow your portfolio and maintain that stability, that because everything will fall apart around you if you don't have that comfort level. Once you have that comfort level, then it's about where are the opportunities. And for myself, high cash flow in single family, which was very accessible in the Great Recession. Then it went to houses were starting to get priced out of the range for cash flow. So it was like head over to multifamily. Multifamily moved down in the cap rate situation. And it got to the point where it was like the next opportune asset in my market that I was comfortable with was self-storage. How much different could it be? Yeah, there's more doors and things like that, but it's less touch points. There's no toilets and things like that. So we entered into that, learned our processes that we've put in place after observing and monitoring and learning from around us, put those things into place, got a stable process. We ran our operations really well. Over the year and a half after we started into self-storage, those cap rates started to compress substantially and drop right down to where multifamily was. So at that point, we were like, we can buy opportune properties, but we're not going to be out there wholesale buying self-storage because we're not getting the returns that we used to. We're not going to deliver to the investors what we were before. So if we can't find the right asset that has rental increases or something like that can drive the value, it wasn't going to provide what we wanted to for the additional work that it was going to create. Mm-hmm. So we started migrating into some commercial assets where we could find the right properties. And the one thing that we found with commercial properties is we always buy in a preferred area or location, because commercial properties can go vacant based on the economy. There's not a necessity for a business to exist during slow economy. People have to live somewhere in houses and apartments and things like that during a slow economy. They may double up in some properties and things like that.
Yeah.
But that's relatively insignificant compared to the number of businesses that can evaporate when dollars disappear. So we bought some commercial assets in high traffic areas along highways and things like that would stay as a preeminent location just because of the advertising that comes from the traffic. So we bought some assets there. We stabilized our portfolio, and we've been steady now with our portfolio, just looking for with interest rate rises. Now we're coming to a term of a hold period, and we're trying to figure out, is it time to exit? If it is, we'll redeploy those assets in another place. Frankly, have yet to identify what that is because we don't know where interest rates really are going to settle out. So we'll cross that bridge and we'll make those decisions. We continue to monitor the whole market, but that's the progression that we've been going through those assets.
Yeah, and that makes a lot of sense. And I think the thing too is you've been nimble in being able to move from asset to asset, which just gives you more flexibility in deploying that capital that you have. Because if your respective asset market there's always deals. People will say there's always deals to be found. But when it takes a year to find the right deal as opposed to a month, you don't want that capital sitting around. And so maybe you look at those other assets. I have not gone into self-storage, but I definitely see how there's benefits there. The low touch aspect, right? It's very low, not management intensive, I guess is the right way to put it. which is really attractive because you can automate things in a way that saves your time and allows you to find more assets or improve the product, get more units rented, etc. And then they just have different benefits from an investment standpoint too. From the passive investors standpoint, it might be different hold times for those different types of assets, especially with something like commercial where, you might have a 10-year triple net lease, which is a completely different investment picture compared to, I don't know, a 5-year hold value add multifamily, for example.
Great.
So I think it provides choices and options if you have passive investors as well to bring in different types of investors, because ultimately no one should be investing in something that doesn't meet their investing goals. And if you deal in one product, that's okay, right? You're the expert at that product, but you're going to be limited to those investors who want those returns or that risk profile, whatever it may be.
Or the term of the investment. Yeah.
Yeah, exactly.
We've overlapped all of those assets. And I just sold the last single family house, the last two, just about 4 months ago. As we've exited, real estate has peaked and like single family homes are at the resale level. It's starting to stagnate a little bit. And we finally moved out of those assets and effectively moved the money into private money lending activities in the short term, where we can still generate the revenue that we want to generate or return at a pretty good clip, but stay very liquid for wherever things start to move around here over the next year and a half. So we'll stay in that mode, relatively liquid. We'll continue to evaluate the positions that we have in our syndication activities and when the right time might be to exit that. But we'll just monitor what's out there to where we go to next. And it may be back into an asset class if there's a change in structure, or we may move into a more concentrated into some specific asset class if it's appropriate going forward.
Yeah, and if you could quickly break it down to me, if I'm the passive investor and I'm looking at the offerings that you have, how is my money being invested? Because you just talked about it being a fund. Am I investing in a fund that is associated with a specific deal, or is it a specific asset, or what does that look like from the passive investor's perspective?
Sure. When we do syndication, it is specific to a property or a specific deal. It could be a bundle. We could buy multiple assets. In one case, our syndication has 4 different self-storage unit sites on it. Or, I'm sorry, spread across the city within it. So in some cases, it may be a diverse set of properties, but generally speaking, those are one-off purchases, one time in, one time out. We're now working more in a structure after several syndications. There's a cost to that structure. So we're actually now starting to work under the fund to funds structure, where we're actually creating the documentation set one time, but then we do individual offerings for different types of investments that are within that fund. And individuals can elect to be in very specific ones and garner the return of that specific element. So let's say we want to do a private money loan and you're in the fund, you can elect to put your funds into that private money loan and you will get the returns from that private money loan. Obviously, it bears the risk of only that private money loan, but generally speaking, you could also elect to go into 5 different ones if you wanted to over a period of time and kind of ladder the ins and outs of those funds. So all of those things can become options in funds, and there's different ways to structure them, but our particular one affords us the opportunity to do a variety of different asset classes all within there with I'll call it very low friction from a cost of establishment of each of those forward-looking investment opportunities.
Yes, yeah, that seems like if I'm the investor, right, like it gives me the opportunity to, one, diversify if I want to get into different asset types that you offer, but also it gives me choice, which a lot of people like choice. I think that's the concern that some investors have with, we'll call them blind funds. Some people say, hey, we will invest in a ground up development Class A projects. That's what we will invest in. You're not choosing the project. We're just telling you, if you invest your money, no, that's what it's going to go into, and these will be your general returns. And some people understandably are uncomfortable with that because they want to be able to vet each deal as it comes along on its, on its merits and invest that way. So that's interesting and I've heard of the type of fund that you're talking about, but it's not as common yet, I don't think.
Right.
So it's interesting to see.
Yeah. And I agree. I come from the background. It's hard to do due diligence if you don't know what you're putting it into. So you really are trusting the operator or the general partnership in identifying and vetting those opportunities, because you will not know what they are ahead of time. All you know is it's an asset class. And the best you can think is, I'm market timing in a particular investment class, and it is an opportune time and they'll probably do well. Beyond that, you're trusting the operator to do all of that underwriting and deliver on it.
Yeah, that gets tricky. All right, Jeremy, it is time to go into the turbo round. So if you're ready, I'm going to ask you 3 questions that I ask every guest that I have on the show, and I just ask for a quick, honest answer. You ready?
Sure. Yep.
All right. First question. What is one red flag every investor should look out for?
I would say cheap real estate. It's usually cheap for a reason.
Especially now, yeah.
But due diligence, right? And being able to identify what is that value and is it really a value? Because shiny object or best price or stuff like that isn't always the indicator of where your best value is for your investment.
All right. What is a myth about this business that you would like to set straight?
I think it's having to be active in it. I started in the whole process thinking everything had to be hands-on. That is a myth. Now, if you want to be hands-off, you need to be very knowledgeable so you know the proper place to invest in, because there's ample places to put funds and you can lose all of those funds. So you need to at least become educated enough in order to invest in the right places, but you don't necessarily have to be active to be in real estate and to learn it and get through it and become wealthy from it.
Yeah, absolutely. All right. Final question. What does success look like to you?
For me, it's getting the flexible time freedom that comes with real estate at the right scale. Work your way through the W-2 transition into active real estate, having some flexibility, and then eventually building your wealth in with the idea that you can move your investors on and you can become the passive investor and have that time freedom and do as much work as you want to do within real estate. But generally speaking, there's more than enough activity just in doing the due diligence for your own investments that when you get to the right size, I believe that you can be 100% passive investor and still stay close enough to the market, just managing your own investment portfolio. And that's where I'm targeting getting to now. I'm at the point where I can achieve that. I just have to migrate my portfolio to the performance of my time freedom to that level, exiting syndication activities that we're currently active in. So that's my next step over the next 2 to 3 years. And the thing about real estate is it's not like the stock market where you just can't go push the sell button on the next open market day. This is a 3 to 5 year strategy, ins and outs of everything, because you can lose significant amounts of money if you must exit when you don't want to exit. So exiting at the right time and having that plan and migration and working towards those things in steps, it's the best way to get into it without becoming overwhelmed. And it's the only successful way to really exit it without having a detriment of sale values or something like that, fire sales.
Yeah, I'm right there with you. I'm looking forward to the day when I can transition into limited partner status on my terms. But as you said, it's all about timing. You definitely don't want to have to sell when it's not the time to sell. All right, Jeremy. Hey, this has been awesome. I really enjoyed the conversation. Please tell the listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
Sure. You can reach out to me. I'm up in the Wisconsin area. So if you're in this market or in the greater area, feel free to reach out to me anywhere in the country. I'm always following real estate all over the country for the different markets. And you can reach me at jeremy@lemere.com. Pretty straightforward. First name at last name.com. And you can always visit starcmg.com and hop on our investor side and follow us along there. And if you want to invest in our fund, and to be in the passive side, we're certainly open to working with folks on that side too.
All right, we'll have all that information in the show notes. Jeremy, thanks again for coming on, and I look forward to seeing you continue to do big things on your journey to multifamily millions.
Super. Thanks, Tim, for having me.